the $50 billion lie that crashed the world economy. September 15th, 2008. Thousands of employees, dressed in their Wall Street best, are walking out of a shining skyscraper in New York City, carrying cardboard boxes. They aren't just losing their jobs. They are the first casualties of a lie that's about to send the entire world into a blind panic. This wasn't a random market fluctuation or some unavoidable disaster. This was the day the world started paying the price for a $50 billion deception. The collapse of Lehman Brothers, America's fourth largest investment bank, was the largest bankruptcy in U.S. history. It was the single event that tipped the globe into the worst economic crisis since the Great Depression. And at the heart of it all, a deliberate, calculated, and frankly, audacious accounting trick designed to do one thing: hide the truth. This is the story of how one of Wall Street's most powerful banks disguised over $50 billion in toxic debt as sales, fooling regulators, investors, and the entire world. This is the story of the lie that broke the global economy. In the mid-2000s, Wall Street was a kingdom of unchecked ambition, and Lehman Brothers was basically royalty. Founded way back in 1850, it had survived everything: world wars, market crashes, you name it. Under its CEO, Richard Fuld, a man nicknamed the Gorilla of Wall Street for his aggressive style, Lehman became an absolute titan. Fuld had transformed the firm into a powerhouse, especially in the red-hot U.S. housing market. Their business model seemed almost intoxicatingly simple. Buy up thousands of mortgages, bundle them into complex financial products called mortgage-backed securities, and then sell them to investors across the globe. And for a while, it was a money-printing machine. Lehman's stock was soaring, hitting a record high in early 2007. The firm looked invincible, a monument to Wall Street's own genius. But under the shiny surface, a poison was spreading. The mortgages they were snapping up were increasingly subprime, loans handed out to borrowers with shaky credit, people who were far more likely to default. Lehman was gorging on risk, borrowing huge amounts of money to fund its bets. For every $1 of its own money, the bank had borrowed over 30. This strategy was wildly profitable, as long as the housing market only went up. But if it turned, the firm would be catastrophically exposed. Lehman's executives knew they were sitting on a time bomb. Their books were loaded with assets that were quickly becoming toxic. Publicly, they projected an image of unshakable confidence, but internally, they were scrambling for a way to make their balance sheet look less like a five-alarm fire. They needed a miracle. Or, as it turned out, a clever accounting gimmick. The lie was called Repo 105. The name is technical and boring, and honestly, that was part of its genius. In reality, it was a simple but incredibly bold shell game. Here's how it worked. Usually, when a bank needs short-term cash, it uses a repo transaction. Think of it like a pawn shop for financial giants. A bank gives another firm some assets as collateral for an overnight loan. The next day, it buys back the assets for a tiny bit more. Crucially, under normal accounting rules, this is treated as a loan, and the assets stay on the bank's books. But Lehman found a loophole. An obscure accounting rule said that if the assets were valued at more than 102% of the cash received, the deal could be classified as a true sale instead of a loan. This meant the assets, and all the debt attached to them, could be wiped from the balance sheet, just like that. So, Lehman created Repo 105, where they would repurchase their assets for 105% of their value. Right before the end of every financial quarter, Lehman would go on a Repo 105 spree. They would sell tens of billions of dollars of their riskiest assets to banks in London, because no U.S. law firm would give the scheme its blessing. For a few critical days, their balance sheet would look magically healthy, showing far less debt and leverage than they actually had. They were actively deceiving rating agencies, their own investors, and the public. At the end of 2007, they used Repo 105 to hide nearly $39 billion. By the first quarter of 2008, that number hit $49 billion. And by the second quarter, just months before the crash, they were hiding over $50 billion. Internal Lehman employees later called Repo 105 an accounting gimmick and a lazy way of managing the balance sheet. It was a deliberate deception to hide the rot at the company's core. Armed with these fake reports, Lehman could keep borrowing money and maintain its sterling reputation, all while the clock was ticking down to zero.
Throughout 2008, the U.S. housing market went into an absolute freefall. Subprime borrowers started defaulting in record numbers. The mortgage-backed securities Lehman was holding, once seen as golden assets, were now turning into financial poison. The Repo 105 trick could hide the problem, but it couldn't solve it. In March 2008, the first big domino fell. Bear Stearns, another investment bank drowning in toxic mortgage assets, collapsed and was sold off in a fire sale. Panic began to ripple across Wall Street.
Suddenly, all eyes were on Lehman Brothers.
CEO Richard Fuld remained defiant, but the market's confidence was evaporating. Lehman's stock price cratered, losing over 70% of its value in the first half of the year. Potential rescuers, like the Korea Development Bank, took one look at the true state of Lehman's books and walked away. The firm was hemorrhaging cash and completely running out of time. The final frantic weekend kicked off on Friday, September 12, 2008. The U.S. government, which had bailed out Bear Stearns, made a decision that would change history. There would be no government rescue for Lehman Brothers. Treasury Secretary Hank Paulson told the heads of Wall Street's biggest banks that they had to find a private solution, or Lehman would be allowed to fail.
A weekend of desperate meetings took place, but nobody was willing to swallow the black hole of Lehman's toxic assets.
The house of cards had finally collapsed.
On Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. With $639 billion in assets and $619 billion in debt, it was the largest bankruptcy in American history, dwarfing every corporate failure that had come before it.
The news hit the world like a shockwave. The Dow Jones Industrial Average plunged over 500 points, its worst single-day drop since the 9/11 attacks. The $50 billion lie was out in the open, but the consequences were just getting started.
The story of Lehman Brothers is a brutal reminder of how quickly greed and deception can spiral into a catastrophe for millions of ordinary people. If you find these deep dives into financial meltdowns compelling, make sure to subscribe and hit that notification bell. And let us know in the comments, what financial scandal should we unravel next?